So good morning, everyone. On behalf of the Illinois Small Business Development Center at Chinese Mutual Aid Association, welcome to our final webinar series with First Midwest Bank. Our speakers today have a lot of experience in financial management, so I really encourage our viewers to ask questions about your business in the chat box. I first want to introduce our two guests today. First, we have Al Swaiz, Vice President of Treasury Management. Al has almost 30 years of experience of helping businesses streamline their finances by managing cash, investments, other financial assets, and optimizing their liquidity while also mitigating its financial, operational, and reputational risks. I'm also very delighted and honored to introduce our board president, Chinese Mutual Aid Association's very own Mike Chin. He is the vice president in First Midwest Business Banking Group and has almost 30 years of experience in commercial banking, commercial real estate, and middle market lending. Mike was also recently honored as Crain's Chicago's notable minorities in commercial banking. If I were to describe Mike, I would say that leadership is not a position or title, it is action and example. We're so thankful for Mike's leadership, for all he's done for all of our nonprofits across Chicago, and especially at Chinese Mutual Aid Association for helping strengthen our finances and operational budget. So we're just so lucky to have these two guys today with us today. And with that, I'd like to pass it over to you. Mr. Vice President, the floor is yours.
Thanks, Tommy, for those really kind words. And welcome everyone to today's financial seminar. And what we're going to be covering off today is a few things. We're going to go over the benefits of financial management. We're going to be discussing budgeting, bookkeeping, actually going over the financial statements like the P&L and the balance sheet, business financing. When you have your financial information available and you're ready to meet with a banker, and then key points to remember during that process, and then we'll also have a Q&A session. So today's objectives, what we want to cover is the concept of financial management and its importance for not only the small business and its owner, because you always want to know where the business financial situation is, but then also for your financial partners as well, such as your banker. Identify financial management practices. Let's take a look here. Next slide, Emily. And then identify financial management practices, rules, and tools commonly available to the small business. And then also explain how financial management practices, rules, and tools work, and kind of bringing it all together. Next slide, Emily. So we'll go over the financing basics for a small business, which includes startup financing, financing for a growing business, financing for working capital, and also financing for fixed assets, since there are different loan products for those specific needs. Next slide, please. And so what do we want to know or learn about financial management? Next, please. So we want you to reach your financial goals by making good decisions, and that's also having good financial statements. And so what they'll tell you is you'll know your profitability. It'll allow you to make plans to forecast your growth. It'll also allow you to plan for diversification, new different customers, new product lines, reaching new markets, and also prepare for financing and obtaining loans. Next slide, please. So there are several financial management practices and tools that are commonly used for small businesses, and what we call that is, a budgeting or forecasting. Next slide. So we'll go ahead and go over each category, and then kind of explain what categories you use and tracking your monthly expenses and how this helps with your business decisions. Next slide, please. So a critical component of financial management is bookkeeping. So you got to be able to pull kind of your receipts, your invoices all together and organize a process of tracking, all your income and all your expenses. And so your basis for all financial management, your business decisioning, your financing, your taxes, owner's draw, salary, and retirement is really all based on your ability to maintain good financial statements for your business. Next slide, please. So here are 10 basic bookkeeping steps. So first, you obtain a business accounting software. What's pretty popular in the marketplace is QuickBooks. And what we like about QuickBooks is, you can start with, the initial modules for your business in like sort of a startup stage. But as your business grows, you can always add on modules to QuickBooks as, your business expands. And so it's not necessarily you need to go to a whole new software system, but QuickBooks allows you to add modules as your business grows. And then you also open a separate business checking account, so you kind of make sure that the sale proceeds for your business gets deposited into your business account versus commingling it with your personal account. And then you want to reconcile that checking account as if it was your own personal account. Track sales and deposit all sales. Next slide, please. You also write business checks for your business expenses. And so that's also easy to go back for bookkeeping purposes as well, is you kind of keep track of the business checks that you do write for your expenses. And then you also obtain a separate business credit card for that business. Again, a really nice tool for monitoring your spend on your business. And then, rule of thumb is you pay your business expenses first, and then you generate a profit and loss statement, basically kind of based off of your deposits and also the checks written. And then at the end of the day, if you have a profit, then you pay yourself with an owner's draw. Next slide, please. So the key to, kind of like I always say, like garbage in, garbage out. So you really have to organize and complete your daily accounting task. And so that, of course, starts with creating a good accounting report, such as cash flow statements, which helps you track the financial health of your business. And then also, don't use paper to run your business. We've got clients that will have sort of your 8.5 by 11 ledger pad of paper, and they're trying to maintain everything on that. And so at the end of the day, for proper financial management and growth of your business, you should use a software to stay on top of your financials. Next slide, please. So your financial statements are reports about your business's financial health and cash flows. Because if you don't know your company's financial health, it's going to be a challenge to kind of make critical decisions about your business thereafter. So there are three basic statements, which is the balance sheet, a cash flow projection, also sometimes called a cash flow statement, and then a profit and loss statement, also known as a P&L or income statement. So those are kind of the three key financial statements that you should know how to create. And your accounting software would help you create these documents. Next slide, please. So a snapshot of a business at a specific point in time is your balance sheet. It'll have your assets on the left and your liabilities or debt on the right. And so your totals on both sides will equal. So you'll have your assets and then your liabilities, and the difference between subtracting your assets from your liabilities is your owner's equity, or kind of the profit that you've built up in the company, plus your initial investment. Next slide, please. So here is an example of a balance sheet. Again, which it's got your cash. So again, if you open up a separate checking account, that will be an easy number to pull. Your account receivable is if you're a company that, say, invoices for a sales transaction, but you don't receive payment, for example, 15 to 30 days because you provide your client terms. So that would show up as an accounts receivable as an asset because you have cash coming in based off of a sales transaction. And then your inventories. And so if you do maintain inventories, if you sell clothes or sell other wares, whatever you have in the shelf and in the warehouse, that's your inventories. And also your prepaid expenses. Just an example, if you pay your landlord 3 or 4 months worth of rent ahead of time, that would be considered a prepaid expense. And then if you own your building or if you own equipment, that would show up in your what we consider long-term assets, because those would say a turn or there's value there that's beyond 12 months. So that would be your long-term assets or your fixed assets. And so then you would add those items up, and that would give you your total assets. And then your liabilities is, if you have accounts payable, that would your vendors would show up on that line item, taxes payable, other liabilities. And so that would be your current liabilities, which again, usually within 12 months, those are paid. And then you have your long-term debt, which is debt that's paid beyond 12 months. And that could be a mortgage or an equipment loan, or an automobile loan that you have on your company's books. And that would be what we consider a long-term liability. And so again, the difference between your assets and your liabilities would show up as owner's equity. The common stock is usually the initial investment, and then the retained earnings is the profits that you maintain in the company, and then you sort of carry over your profits thereafter. And so that's what really kind of puts together the core pieces of your balance sheet. Next slide, please. So another important document is your cash flow statement. So the definition, or the two primary definitions, is your balance of cash received less than the amount of cash paid out over a period of time, which is really kind of keeping track of moving the cash in and out of the business. Next slide, please. So a financial statement uses financial assumptions to forecast. So the company cash flowing in and out, future cash flow during a specific time period, and project whether cash receipts, which is your inflows, incoming cash, will be sufficient to cover projected cash disbursements or your outflows. And so this is a really key component when you're kind of forecasting your business. And so sometimes clients will kind of start doing somersaults because they've secured a contract with either Walmart or Walgreens for their product, but then if they don't do a proper cash flow projection, they may find out that at the end of the day that Walmart or Walgreens contract isn't as profitable as they expected. And so a cash flow projection would help determine when you enter in an agreement with a potential new customer, whether that agreement is profitable for you at the end of the day. Next slide, please. So cash flow projection, how can cash flow projection help, and when do you need one? So again, this is a critical piece, and I think everyone should go through this exercise. So you set your sales and expense goals, determine a break-even point. So you know if you're pricing your product or service properly. Plan on equipment purchases for replacement or expansion. And then also determine if the cash needed to purchase inventory for seasonal cycles. And so again, kind of going back to the Walmart and Walgreens example is, in some cases, those clients don't pay like in 90 to 120 days because, they are the big box or the large customer. But then you've got to pay your supplier within 30 days. And so you've got a cash flow gap because you're not getting payment for 90 days, but you've got to pay out for those inventory or raw materials in 30 days. And so that's why doing a cash flow projection is key. Next slide, please. So how can a cash flow projection help, and when do you need one? So again, I think everyone needs to go through this exercise, and that's when you sort of lean in on an organization like Tommy and the Chinese Mutual Aid Small Business Development Center, because they will assist in kind of these documents that I'm going over with you today. So you track liquidity when accrual accounting math your cash realities. And so that's, again, going back to the example, accrual accounting is when you're doing invoicing. And so that's why you really got to understand the nature of your cash inflows and outflows, because accrual accounting is if you're invoicing and you don't expect payment for 30 to 60 days, depending on the terms that you're giving your customer. It'll help determine your sort of the cash flow gaps between when you get paid and versus when you have to make payments out. So that difference is really kind of helps you determine the need for financing or what we call working capital. And then you need to prepare these documents to show your lenders or the banks your ability to plan and repay financing. So the more knowledgeable that you know about your cash flow gaps, again, the more credible you appear to your banker or your lender. Next slide, please. So again, Tommy's going to be providing a recording of this deck for you, and so I'm not going to go over this cash flow section line by line, but the key points is it's your sources of cash, your operating use of cash, and then sort of the non-operating use of cash, and you kind of go through this this nice box and try to fill in those items, so then you can understand perhaps where the gaps in your cash inflows and outflows are. Next slide, please. So discussion point for cash flow projecting again is to increase cash flow. The owner could increase the number of items sold. So of course, increase your sales to increase your cash flow. That's an easy one. Increase the price of your product. Reduce expenses. Change the timing of your expenses, meaning if you could ask your vendor, instead of giving you 30-day terms, now you ask for 60-day terms, and now you've sort of covered perhaps a 30-day of cash flow gap. if your customer is paying you in 90 days. And then also save money to have sufficient opening cash to get through a startup period. And so that's kind of the initial capital that you would either invest or into the company, and just make sure you have sort of that cash flow cushion. Next slide, please. Obtain sources of cash other than sales. And this is what they're referring to is a bank financing or a line of credit, which again the banks call working capital, which again provides that gap between your cash inflows and outflows. Reduce or change the timing of the owner's draw, and we've seen that happen in cases as well. Is where if the business is sort of in a cash flow crunch, sometimes the owner will forego his or her salary for a time period. Buy inventory from a different vendor at a lower price, and so because now you've sort of increased your profit margin, there's more cash to retain in the business. Obtain credit from a vendor. Again, that's asking for terms from your supplier or vendor, which is a form of obtaining credit. And then also establish policy to get paid sooner by your customers. And so if your client is paying you 90 days, sometimes you can go back to them if it's been a sort of long-term relationship and ask to get paid, in 60 days or less. Next slide, please. Profit and loss statement. It kind of extrapolates the information in that cash flow document that we just talked about. So that kind of measures your revenue and expenses over a period of time, and then it also tracks the profitability where the business is making a profit of. If it's determining if you're making a profit on what you're selling or providing service of. Next slide, please. So a P&L statement or profit and loss or income statement shows how successfully the buying and selling process has been managed. Basically, how well your business revenues are versus your expenses. It also measures the ability of your business to grow, repay debt service, and support you as the business owner. As it states, the P&L is probably the most important report from your accounting software or what you are kind of doing your analysis. And you should do an analysis on your P&L monthly at a minimum, quarterly. Next slide, please. So the P&L is pretty basic. So it's your sales minus your cost of goods sold, which gives your gross profit, and then it's your minus your overhead, which is your net profit. So sales, of course, again, is the revenue that you're generated from the product you sell or your service. Cost of goods sold could be what you are paying for the raw materials to create your product, and so that gives you your gross profit. And so it's a good determination right out of the box if the business that you're doing is profitable or not, just on sort of the where you're pricing your product and what you're paying for the raw materials to make the product. And then you subtract out your overhead, and so that would be your utilities, the rent or the mortgage that you're paying for the space where you're occupying your business, and then your shipping costs and other expenses that's necessarily to run your business. And that at the end of the day will let you know if your business is profitable or not, which is your net profit. Next slide, please. So again, the net profit, if the business is making money, it goes down to the owner, and the owner's draw, or the sole proprietor. And we've seen clients that will sometimes do a year-end distribution, depending on how profitable that company was for that year. And it also will determine, based off your P&L, future expansion and equipment needs. That means if your business is doing really well and you're figuring out that, boy, I'm making a pretty decent profit margin on my product, maybe I want to expand, but for me to expand and create more product, I got to buy more equipment. And so that's what your P&L will help you as well. And then if you're making a lot of money, and you want to reduce your debt, then you could also pay down your principal loan repayment, pay off your loan sooner, and then your P&L will also tell you again how much money your company is making, and it also help you forecast how much income taxes you'll have to pay for that year. Next slide, please. So how do you compile a profit and loss statement? And again, it's pretty easy as long as you're keeping good records. And so if you're not inputting all the expenses that's related to that day's or that month's sales, again, it's sort of garbage in, garbage out, because if you're not putting all the expenses, then you're kind of giving a false sense of how much money you're actually making. Next slide, please. So what do you see? Is the business well managed? Does any problem stand out? And again, an easy problem would be, instead of a net profit, you're seeing a net loss. What about growth potential? Will the business support the owner? So going into this venture or having an existing business, is it as profitable as you expected? And will the business be able to get a loan? And so again, if you're forecasting for negative profitability, then it's something that you'd want to sit down and have a hard discussion with yourself on. And if you're not making money, then the ability to probably get a business loan is pretty unlikely. Next slide, please. What is business financing? Financing is getting the money you need to start, operate, or grow your business. So financing concepts: equity financing versus debt financing, financing working capital versus financing fixed assets, and financing, again, with banks, we have to go through a credit approval process. Next slide, please. The do's and don'ts for small business financing. So invest your own money. Equity is usually cheaper than financing. So that's where initially, and it's also a positive for the banks to see as well, is when it's well capitalized, or the owner puts in his or her own money into the company first. Then you earn the right to borrow. Again, that's a track record in showing profitability of your business through the financial statements that we just went over. Show profitability, which again is determined by your P&L and your cash flow analysis. Understanding and keeping working capital. And so that working capital could come in the form of, again, retained earnings, the profits of your company, kind of retained in the company, and that's, of course, would be reflective in your business checking account or other accounts that you keep on the business. Be lean on fixed assets. We sometimes get these companies or these individuals that want to buy the best and brightest thing that's out in the market. But at the end of the day, those pieces of equipment may not generate as much cash as you would expect, and so that's why you kind of be lean on the fixed assets or the capital expenditures for your company, and then you want to match your sources and uses of funds. And so that means if you're buying a piece of equipment or a car for the business, you want to make sure you take out long-term debt, which again is something that's repaid beyond a 12-month time frame. And so you want to match your debt or the loan that you're taking out with the type of asset that you're looking to acquire. And so a line of credit is what we consider a working capital line, and that again fills those short-term gaps between when you're getting paid by a client versus the time frame when you got to pay a vendor for those raw materials. And so that could be a 30 to 60-day gap, and so that's what a line of credit is used for. And so that's why they say matching your sources and uses of the funds. Next slide, please. The do's and don'ts for small business financing. So a critical piece is understanding your financial statements. If you don't understand your financial statements, how would you expect your banker or lender to understand them? Because as we're going over your financial statements, we're going to have questions. And so if we're asking you questions, and so since you're the ones that put together the financial statements, you should know those like the back of your hand. Understand your collateral options, meaning a bank is always going to ask you what is your collateral for the loan. And so for working capital lines, that's your receivables and your inventory, because again, those items should cycle, within a short period of time, versus buying a piece of equipment, an automobile for the business, or a building loan. Those are what we consider collateral for financing those type of products. Understand your risk and costs for the various loan types. No grants, and meaning that if you're a for-profit company, it may be a challenge to obtain a grant. However, again, in the time period of COVID, there are grants for businesses at this present time. Shop around. Sometimes it's to your benefit to go to various financial institutions to make sure that you're getting the best structure and the best rate on what you're asking for. And then this is where Tommy comes in, is get expert advice. So from your SBA or SBDC, or if you have a current bank that you are working with, always talk to your banker as well. Next slide, please. So steps for getting ready for a loan. So you should have a business plan. And the business plan usually comes into play when you're either a startup or you're looking to expand your business. A business plan is pretty critical. And then, of course, in that business plan, you will include what we call a kind of a pro forma P&L or profit and loss or income statement that kind of determines that your business or the expansion of your business is profitable. Know what you can afford. And again, your financial statements will tell you based on the profits you expect on how much you could afford. Study your financial statements. Check your credit report. It is important to have a good credit guide score, because it kind of helps the bank determine that you could have a good history of making your payments. Whether it's if you maintain your payments personally, the assumption that that's going to translate to you making your business payments properly as well. Establish collateral options. Show your equity contribution, which again, when we're going over the balance sheet, that would be that common stock, which is the initial contribution, and then the retained earnings is your profits retained in the company, which is your equity. And then research your financing options. Next slide, please. The common elements of the loan package that we see, again, a business plan. If you're starting up or if you're expanding, the business financial statements very critical. We typically ask for interim financials for the year that we're in, and then also historical, meaning that we'll ask for 2 years worth of tax returns on the business, and also personal financial statement is important, which is usually the application that you would be completing for the bank, and then personal and business tax returns. And again, usually it's 2 years that we ask for. Next slide, please. What elements of the loan package? The source and amount of equity contribution we talked about. The credit report, which the bank would be pulling because of the application that you're providing, allows the bank to pull a credit report. The collateral, again, that would be whether you're buying a piece of equipment or purchasing a building for your business, or if you're asking for a line of credit, you would demonstrate that you have so much in receivables or inventory, and that would also be provided in a reports in the software package. There is the ability to generate an accounts receivable report, and then also the ability to generate an inventory report. Agreements, appraisals, contracts, and estimates. So those would be, for example, fixed assets that you're looking to acquire, whether it's a building or a piece of equipment. Next slide, please. The criteria for qualifying for a loan, we went over having a good credit guide score, equity contribution. So, the owner has put money into the company versus, wanting a bank to contribute the startup expenses for a business venture. The repayment ability, which again is determined by your P&L or your profit and loss statement and your statement of cash flows, kind of will show us that your business is profitable and it's got the ability to repay the loan. And then loan to value. So when we do finance, whether it's a building or a piece of equipment, it's typically we want to see the owner's equity contribution in that asset first, which is typically 20 to 25%. Next slide, please. And so startup finance or financing options for a startup business. You've got your equity, which again is the cash that you're putting into the business. Sweat equity, which if you versus asking a bank to finance the build out for say it's a restaurant, and you're going to do the build out yourself, that would be sweat equity because you're creating value in the space that you're occupying. Business credit card, that's would help with your cash flow cycles again, because sometimes you can use a business credit card to pay your vendors, and then with that credit card you would have terms for that repayment. And then family and friends, which is always popular for a startup business as well, is they provide sort of that initial equity for the startup of the business. Next slide, please. And so where should you look for a business loan? Banks, of course, is an option. And when they say regional lending organizations, there are new, I wouldn't say new, but there's more online lending options for small businesses now than, say, 3 years ago. And so, however, that's where we kind of go back to a previous slide discussing shopping around, is that those online lenders usually have a higher costs with borrowing from such organizations. So that's something to keep in mind as well. And then you also have your SBA options, which again, the SBA doesn't actually do the funding. You have to work through still a bank or a lending institution to obtain SBA financing, but that is an option as well. Next slide, please. So key points to remember. Financing is getting the money you need to start, operate, or grow your business. You start with a budget. Bookkeeping is key, the basis for all financial management. Purchase and learn how to use a financial management software, like QuickBooks. 3 statements: balance sheet, cash flow statements, and a profit and loss statement is key to know and understand what makes up those statements. So you could tell the story about your business and determine the profitability of the business as well. You separate your personal and business records and funds. Again, try to not commingle personal and business funds and spending. And factors that affect your ability to get a loan: your credit score, your equity contribution, your ability to repay, and then the loan to value ratio that we discussed as well. Next slide, please. So this would kind of come to our Q&A session, Tommy.
Great. Thanks so much, Mike. I really appreciate the wonderful presentation. So, Mike, we have a lot of clients in the audience that are actually working on their business plan right now. I know earlier you highlighted in your presentation, in your 30 years of experience, like what makes a very strong business plan? What do you like to see? And if you could share maybe some personal insights and advice, that'd be great.
Sure. Again, a key to a good business plan is the thought that goes behind those numbers. So when you are putting together a P&L or a balance sheet, which is again critical to the business plan, is that you really know what is behind those numbers that you have listed. So if you kind of forecast revenues to be 500,000 for that first year, you really got to explain to me what's behind that 500,000. I mean, do you already have purchase orders, for a large percent of that? Have you already sort of identified your customer that will be providing that sort of that ability to generate those sales? And then really know your expenses as well. So when you're telling me your cost of goods is X, have you already gone out and sought quotes from providers? And so I can't emphasize enough how important it is to know your numbers and be able to explain the reasons for coming up with those figures.
Thank you. And Mike, what is your advice of cash flow cushion one should have at what percentage to business revenue? And then there was another question that was similar to that. COVID-19 crisis aside, in normal times, is there a general rule of thumb for how much a business should keep in reserves to continue operations in the event of a negative cash flow situation?
Yeah, I mean, I guess there really isn't necessarily a rule of thumb, but if you've got, say, 6 months worth of working capital in your bank account, I mean, that's a good cushion to have. And so when we know that your, say, your expenses run you, I'll throw out a number, $5,000 monthly. And so if it's good to have 6 months worth of sort of working capital on hand, so that would equate out to about 30,000. But and so that means you could weather the ability of really kind of making no money, but still be able to pay your bills for up to six months. So it's just kind of a good number to have in mind.
Great. And then how much credit score is necessary to start a business? And then I guess following up with that, if you do have a low credit score, what is your advice?
With the SBA financing, I think they allow. I don't think there really is a floor for SBA. You would just need to explain the reasoning behind the low credit guide score. Whether it's medical collections, and those have. Of bringing down a credit guide score. But if you can explain that the reasoning behind the derogatory items on a credit bureau, it shouldn't shouldn't impede you from still seeking out an SBA or a bank loan. There are financial institutions that sort of use a credit guide score to determine if you would qualify for a loan or not. And in those scenarios, I do see that most credit scoring models have like a minimum hurdle of like 680 is that credit guide score. But again, if it gets kicked out because it didn't meet the minimum requirement, there is the ability to explain again the reasoning behind whether it's late pays or collection items that brought down the credit guide score.
Great, thank you. And then any insight to first year losses and tax write-off?
Yeah, I mean, it's a challenge even for an SBA loan. And again, you should really sort of scratch your head if you're forecasting for a loss. It should actually, there should be a good reason why you're forecasting for a loss, but then again, it should create some pause and if you should move forward with the venture as well. But so if you're forecasting for a loss, and then your other question was tax write-offs.
Yeah, tax write-offs.
So when you're figuring out your cash flow, and this is where it'll help you out. There are what we consider non-cash expenses like depreciation, where you could add back. And so if that's those non-cash expenses, which is acceptable to a bank, is creating that loss, we typically look at for cash flow available for debt services like an EBITDA number, where it's earnings before income taxes and depreciation, amortization. And so those items are allowable for add backs. But if you're forecasting for a loss due to some funky accounting, then that probably wouldn't sit well with the bank.
And then what are the common mistakes you see as a new business owner?
Not knowing their numbers, and that's sort of a again, it kind of goes back, if you're presenting a business plan and you're showing me that this thing is going to make money hand over fist because it's generating X amount of revenues, and and this is your expenses, because I know I'm only going to need so many personnel to run and manage the business. But then if I ask you how you're coming up with your revenue numbers, or how did you come up with so many people on staff, or why are you forecasting your expenses so low? You got to be able to explain to me how you came up with those numbers. And so that's again, it's unfortunately it's knowing your numbers and knowing them well enough that you're presenting them into a profit and loss and balance sheet statement for the bank to review.
And then what should I do if I don't have much collateral to put down to incentivize a lender to give me a loan?
Yeah, that unfortunately, whether it's the SBA or the bank, we're not providing equity to start up a business. And so that's where it is pretty important to seek options, whether it's family, friends, or we've seen some clients who are kind of transitioning in a career where maybe they've got equity in their home, and then they seek a home equity loan first, and that's how they fund the startup of their business. Because if you do look at an SBA loan as an option, the SBA does require putting a lien on your house anyways, and so you're better off seeking a home equity loan first. So you do already have a lien in second position, and you use that equity to fund the business. And so sometimes at the end of the day, that's sufficient, where you don't even need some additional capital for the business. But it is a challenge. It's one of the probably one of the dilemmas that we hear more about, is that there isn't enough equity or owner contribution to provide financing, whether it's SBA or conventional lending.
Yeah, and I guess following up with that, there was another question. When asking for a loan, at what point do you, as the sole proprietor, pay yourself, or as to how much? What do you put for work hours over the length of the loan to pay yourself? And I guess following up with that, in your business plan, should you be mentioning that you will be paying yourself a salary?
Yeah, no, that's included in your income statement. And so when you're putting together your P&L or your income statement, which under your gross profit is your operating expenses, and the first line in your operating expenses is owner salary, which is probably usually the last item that you would sort of complete before finishing up your P&L, because you got to determine how profitable your business is, and if you could afford to take an owner salary or draw. And so that's why I always say, when you're putting together your P&L, if you're only forecasting for $2,000 profit at the end of the month, after you complete your P&L, then it should give you pause again. Should you be starting up this business venture? Because if your profitability is skinny, and if you take that 2,000, you put it back into the owner compensation, and so you're making zero for that month, And that's why it's very important to go through the exercise of creating your P&L. However, if you're making $10,000 a month after you complete your P&L, sure, then you can put in $5,000 as owner salary, because the business is still netting $5,000 in income after you put in your owner compensation.
Okay, and then last question, what are the ratios you like to use to quickly evaluate the health of a business?
From a cash flow standpoint, it should be about 1.2 times after you pay your debt. And so, an easy calculation is, if I'm just using this as an example, if the business is making, say, net 120,000, and then you've got 100,000 in say loan payments, so then you take your 120 over 100, and it's providing a 1.2 times debt service coverage, then that's a good benchmark to know that, yes, I'm making decent money from a bank metrics standpoint. And then from a balance sheet, from what we call leverage, is if you take your total liabilities, and then you've got your owner's equity, which is your initial capital contribution and the money that you retain in the business. If you're less than, say, 4 times, that's a good number, meaning that if you've got 400,000 in total liabilities, and you've got 100,000 in retained earnings and common stock, then that's another metrics that the bank uses, that your leverage is only 4 times, and so that's a good number too.
Great. Thank you so much, Mike, for a wonderful presentation today. Thank you for Midwest Bank. I also want to thank Al. I know he was here as backup in case Mike's Zoom went out. So thank you so much for being here. And thank you to all our attendees for attending our webinar. We'll be sending a recording and PowerPoint after later today. So thank you so much. And if you have any further questions, feel free to reach out to me. Thank you, guys.
Great. Thanks, Tommy. Thanks, everyone.